This presentation is for Chapter 9, Plant Assets, Natural Resources, and Intangibles, Exercises E9-17, S9-2, 3, 5, 6, 7, 8, 9, 10, 11, 13, 14, and S9A-15 and 16. You should pause the presentation and complete these exercises and come back to check your answers. In this exercise, Lawson Furniture purchased land improvements, and constructed a building. We will be reviewing the items and determining which of these costs belong to each of the three assets. First, Lawson purchased the land paying $65,000 cash, plus they signed a $250,000 note payable. Both of these costs would belong to the land. In addition, they paid $5,000 for delinquent property taxes, $4,000 for title insurance, and $9,000 to level the land and remove an unwanted building. All three of these costs would also be debited to the land account. Next, they constructed an office building at a cost of $400,000. This would be debited to the building account. They also spent $54,000 for a fence, $12,000 for a sign near the entrance, and $8,000 for special lighting of the grounds. These last three items would be debited to the account land improvements. The second part of the question asks which of the assets will Lawson depreciate. They would depreciate the building and land improvements. Land itself is never depreciated. In this exercise, Concord Pet Care paid a lump sum of $210,000 for land, building, and equipment by signing a note payable. At the time of the acquisition, the land had a separate market value of $110,000, the building $88,000, and the equipment $22,000. Adding the separate amounts together, we find that they would total $220,000. So we need to determine the percentage of each of the assets to the total of their separate market values. For land, it would be 50%. For the building, it would be 40%, and for the equipment, it would be 10%. Then, to determine the amount of the lump sum of $210,000 to be applied to each asset, we multiply the percentage by the $210,000 and we get $105,000, or 50% of the $210,000 for the land, $84,000 for the building, or 40% of the total, and $21,000, or 10% for the equipment. To make the journal entry for the lump sum purchase, we would then debit land for $105,000, building for $84,000, and equipment for $21,000, and credit note payable for $210,000. In this exercise, we will be computing the first year depreciation and book value for Air Canadians. Air Canadians purchased a used airplane for $37 million and expects to use the plane for 5 years or 4 million miles, and for it to have a residual value of $5 million at the end of its useful life. The company expects to fly the plane 1,400,000 miles during the first year. The problem asks us to compute the first year depreciation using the straight line depreciation method. To compute straight line depreciation, you take the cost of $37 million, subtract the residual value of $5 million, which would give you $32 million, and you divide this amount by the useful life of 5 years to get $6,400,000 of depreciation for the first year and each year thereafter. Next, we will compute Air Canadian's first year depreciation expense using the units of production method. The problem states that Air Canadians expects the plane to be flown 4 million miles over the course of its useful life. The company also expects for the plane to fly 1,400,000 miles during the first year. To compute the depreciation under the units of production method, we first need to determine the cost per mile. To make this computation, we subtract the residual value of $5 million from the cost of $37 million and then divide the difference, $32 million, by the total number of miles to be flown, 4 million. This gives us depreciation per mile flown of $8. To compute the current year depreciation, we multiply the number of miles flown this year, 1,400,000 times $8 per mile, and we get current year depreciation of $11,200,000. Last, we will compute Air Canadian's first and second year depreciation expense using the double declining balance method. To compute the depreciation using double declining balance, we do not subtract the residual value. We take the cost minus the accumulated depreciation and divide the result by 2 times the straight line percentage. To compute the straight line percentage, we divide the number of years of useful life into 1. In this case, the useful life is 5 years, so the straight line percentage is 20%. So 2 times the straight line percentage is 40%. To compute the first year depreciation, we multiply the cost, $37 million, by the 40%, since there is no accumulated depreciation, and we get depreciation of $14,800,000. To compute the depreciation for the second year, we would subtract the accumulated depreciation of $14,800,000 from the cost of $37 million to get $22,200,000, and multiply that by 40% to get the depreciation for the second year of $8,880,000. This process would continue until we reach the residual value of $5 million, at which time we would not depreciate below that amount. The last requirement in the problem is to show the airplane's book value at the end of the first year for all 3 methods of depreciation. To compute the book value, we take the depreciation from the cost. This schedule shows the book values for the airplane under each of the 3 depreciation methods. In this exercise, we will compute depreciation expense for a partial year. The problem tells us that Rural Tech Support purchased a copy machine for $53,400 and expects the machine to last for 6 years and have a residual value of $3,000. To compute the depreciation expense for the machine for the year ended December 31st, 2017, using the straight line method, we would subtract the residual value of $3,000 from the cost of $53,400 and get $50,400, which would be divided by 6 years for an annual depreciation amount of $8,400. To determine the depreciation for the 10 months that the machine was owned in 2017, we would multiply the $8,400 by 10 divided by 12, and we get $7,000 for the partial year of 2017. In this exercise, we will assume that Smith's Auto Sales paid $45,000 for equipment with a 15-year life and 0 residual value. After using the equipment for 6 years, the company determined that the asset will remain useful for only 5 more years. The problem asks that we record depreciation expense on the equipment for year 7 using the straight line method. First, we need to determine the book value of the equipment after year 6 using the straight line method. The straight line depreciation expense is calculated as $3,000 per year by dividing $45,000 by 15 years. Since 6 years of depreciation has been recorded, we multiply $3,000 by 6 and get $18,000 of depreciation expense. And now we can determine the book value of the equipment at the end of year 6 by subtracting the accumulated depreciation of $18,000 from the cost of $45,000 to get $27,000. To get the new depreciation expense, we divide the book value by 5, the number of years the equipment is expected to remain useful, and we get new depreciation expense per year of $5,400. We would then debit depreciation expense equipment and credit accumulated depreciation equipment for the $5,400. The last requirement of the problem is to determine the accumulated depreciation at the end of year 7. We see from the T account shown that accumulated depreciation would be $23,400 at the end of year 7. We have 6 years of $3,000 depreciation per year and 1 year of depreciation at $5,400 for a total of $23,400. This exercise states that on June 15, 2017, Family Furniture discarded equipment that had a cost of $27,000 and a residual value of 0 and was fully depreciated. The problem asks that we journalize the disposal of the equipment. To make the journal entry, we would debit accumulated depreciation equipment and credit equipment for the $27,000. This removes the asset and associated accumulated depreciation from the books. This exercise states that on October 31st, 2018, Alternative Landscapes discarded equipment that had a cost of $26,920. Accumulated depreciation as of December 31st, 2017 was $25,000, and the annual depreciation on the equipment is $1,920. The problem asks that we first record the partial year depreciation expense and then the disposal. To record the partial depreciation, we take the annual depreciation of $1,920 and divide it by 12 to get $160 of depreciation per month, and then multiply the $160 by 10 for the number of months that we had the equipment in 2018 before we disposed of it on October 31st, and we get partial year depreciation of $1,600. We record the partial year depreciation expense by debiting depreciation expense equipment and crediting accumulated depreciation equipment for $1,600. To record the disposal, we debit the accumulated depreciation equipment account for $26,600, which is equal to the $25,000 balance at the end of 2017 plus the additional depreciation for 2018 of $1,600. We also debit loss on disposal for $320, which is the difference between the asset's cost of $26,920 and the accumulated depreciation of $26,600. Then we credit the equipment account for the original cost of $26,920. Alpha Communications purchased equipment on January 1st, 2018 for $27,500. Suppose Alpha Communications sold the equipment for $20,000 on December 31st, 2020. Accumulated depreciation as of December 31st, 2020 was $10,000. The problem asks that we journalize the sale of the equipment assuming straight-line depreciation was used. To determine the gain or loss, we first need to determine the book value of the equipment by subtracting the accumulated depreciation of $10,000 from the cost of $27,500, and we get the book value of $17,500. We determine that the gain on the sale is $2,500, which is equal to the difference in the sales price of $20,000 and the book value of $17,500. To make the journal entry, we debit cash for the sales price of $20,000, debit accumulated depreciation equipment for $10,000, and credit equipment for the original cost of $27,500 and gain on disposal for $2,500. Peter Company purchased equipment on January 1st, 2018 for $28,000. Suppose Peter sold the equipment for $4,000 on December 31st, 2019. Accumulated depreciation as of December 31st, 2019 was $11,000. The problem asks that we journalize the sale of the equipment assuming straight-line depreciation was used. First, we determine the book value of the equipment to be $17,000, equal to the original cost of $28,000 minus the accumulated depreciation of $11,000. Next, we determine that there was a loss on the sale equal to $13,000, which is the difference between the sales price of $4,000 and the $17,000 book value. To make the journal entry, we debit cash for the sales price of $4,000 and accumulated depreciation equipment for $11,000 and the loss on disposal for $13,000 and credit equipment for the original cost of $28,000. Ajax Petroleum holds huge reserves of oil assets. Assume that at the end of 2018, Ajax cost of oil reserves totaled $27 million, representing 3 million barrels of oil. The problem first asks, which method does Ajax use to compute depletion? The answer is units of production. The problem then supposes that Ajax removed and sold 500,000 barrels of oil during 2019. The problem asks that we journalize the depletion expense for 2019. To compute the amount of depletion expense, we first need to determine the amount of depletion per barrel. We take the total cost of $27 million and divide it by the total number of barrels, 3 million, and get $9 per barrel of depletion. To compute the current depletion expense, we multiply the $9 by the 500,000 barrels of oil removed and sold during 2019, and we get $4,500,000. To record the entry, we debit depletion expense oil reserve and credit accumulated depletion oil reserves for the $4,500,000. Decca Publishing paid $230,000 to acquire Thrifty Nickel, a weekly advertising paper. At the time of the acquisition, Thrifty Nickel's balance sheet reported total assets of $130,000 and liabilities of $70,000. The fair market value of Thrifty Nickel's assets was $100,000, and the fair market value of Thrifty Nickel's liabilities were $70,000. The problem asks, how much goodwill did Decca Publishing purchase as part of the acquisition of Thrifty Nickel? To determine the goodwill, we first need to determine the fair market value of the net assets of Thrifty Nickel. The fair market value of the net assets is $100,000 minus $70,000, or $30,000. To determine the goodwill, we subtract the fair market value from the purchase price of $230,000, and we get $200,000 as the goodwill. The problem then asks that we journalize Decca Publishing's acquisition of Thrifty Nickel. To make the entry, we debit assets for $100,000 and goodwill for $200,000, and we credit liabilities for $70,000 and cash for $230,000. Notice that the assets and liabilities of Thrifty Nickel were recorded at their fair market value after the acquisition by Decca Publishing. In this exercise, we will compute the asset turnover ratio of Biogas, Inc. The exercise states that Biogas had net sales of $55,600,000 for the year ended May 31st, 2018. Its beginning and ending total assets were $52,800,000 and $98,500,000 respectively. To determine the asset turnover, we divide the net sales by the average total assets of Biogas, Inc. The average total assets are $75,650,000, which is the $52,800,000 beginning assets, and $98,500,000 ending assets added together and divided by 2. Then to get the asset turnover ratio, we divide the net sales of $55,600,000 by $75,650,000, and we get an asset turnover ratio of 0.73 for Biogas. Micron Precision Inc. purchased a computer for $2,500 debiting computer equipment. During 2016 and 2017, Micron Precision Inc. recorded total depreciation of $1,600 on the computer. On January 1st, 2018, Micron Precision traded in the computer for a new one and paid $2,100 cash. The fair market value of the new computer is $3,900. The problem asks that we journalize Micron Precision Inc.'s exchange of computers. First, we need to determine the gain or the loss on the exchange. We take the fair market value of the new computer and subtract the cash paid plus the book value of the old computer. We see that there is a gain on the exchange because the total of the cash paid of $2,100 and the book value of the old computer, $900, is $3,000, and that is $900 less than the fair market value of the new computer, $3,900. To make the journal entry, we debit computer equipment for the fair market value of the new computer, $3,900, debit accumulated depreciation computer equipment for $1,600, and credit computer equipment for the original cost of the old computer of $2,500, credit cash for $2,100, and gain on exchange for $900. White Corporation purchased equipment for $22,000. White Corporation recorded total depreciation of $19,000 on the equipment. On January 1st, White traded in the old equipment for new equipment and paid $23,200 cash. The fair market value of the new computer is $25,100. The problem asks that we journalize White Corporation's exchange of equipment. First, we need to determine the gain or loss on the exchange. The fair market value of the new equipment is $25,100. the sum of the cash paid, $23,200, and the book value of the old computer, $3,000, is $26,200. This is $1,100 more than the fair market value of the new equipment, $25,100, which means that we have a loss on the exchange. To record the exchange, we debit equipment for the fair market value of the new equipment, $25,100, debit accumulated depreciation equipment for $19,000, and debit loss on exchange for $1,100. We credit equipment for the original cost of the old equipment of $22,000, and we credit cash for $23,200. And that is the conclusion of the demonstration for the exercises for Chapter 9.